China's stock market jumps 8.5% as investors rush in. Japan's Nikkei falls nearly 5% on concerns the new Prime Minister there is an interest rate hawk. Australia's housing market is softening a bit. And in New Zealand, business confidence takes another leap higher. That's coming up in our 5 Things in 5 Minutes. And in our bonus deep dive interview, ANZ Economist Maddy Dunk says there are some silver linings in the recent biannual ANZ CoreLogic Housing Affordability report for Australia, as affordability worsened nationally in June.
If you look at Melbourne, for example, one of the consequences of the fact that housing prices have been moving backwards is that affordability is improving for households.
But first, in 5 and 5 with ANZ, there were major moves in Asian stock markets overnight, with Japan's Nikkei down nearly 5% following the election of a new Prime Minister considered a monetary policy hawk who will support further rate increases by the Bank of Japan. But it was China's CSI 300 index which really drew attention, rising 8.5% yesterday as investors rushed in following ongoing stimulus packages announced by Chinese authorities. Iron ore prices also jumped about 10% overnight due to increased confidence these stimulus measures will support construction activity. ANZ economist Bansi Madhavani says a key factor in the stock market surge appears to be traders getting in ahead of the Golden Week holidays that start tonight.
It is therefore likely that FOMO, that is fear of missing out, may have led investors to rush in, and players who may have had short positions so far would have rushed to close out before the week-long holiday. But coming to what the measures of the past few days may mean for the economy, our view is relatively conservative on that front. We think the package will alleviate near-term pressure on economic growth, but follow-up fiscal measures and, more importantly, execution will be the key to determine whether these measures are successful in changing the long-term outlook.
The Aussie dollar got caught up in the positive iron ore and China stimulus wave. It was trading up 0.5% at 69.37 US cents at 4 a.m. Sydney Melbourne time, while the Kiwi dollar was also up 0.5% at 63.72 US cents. Number 2. China's official PMI measure of factory output improved more than expected to 49.8 in September from 49.1 in August. That's still in contraction territory, under 50, but was better than expected and the highest level in 5 months. It also ended a 2-month fall. Here's ANZ Chief Economist for Greater China, Raymond Yung.
The reading is very, very encouraging on the back of all those stimulus package, and that would also be helping the manufacturing PMI to be higher over the next few months. Now we look at the details of this manufacturing PMI number, and we notice that the output and new orders increased significantly on the back of improving input price and output prices. So I believe that the stimulus package will be able to help this manufacturing PMI to be bouncing back to about 50 over the next few months.
Number 3. Raymond says there was also positive moves by local governments in the mega cities of Shanghai, Shenzhen and Guangzhou, which removed long-running restrictions on buying apartments there.
Now, non-residents of those cities are able to buy property in their cities, and also in the case of Shenzhen and Shanghai also are willing to lower the down payment ratio to 15%. I think this is also a very encouraging sign and is consistent with the announcement last week by the central bank and financial regulators. So I think all cities are now willing to execute the property supportive measures by the central government.
Number 4. Business confidence in New Zealand about future conditions in the wider economy and firms' own activity improved markedly in September in the ANZ Business Outlook, as hopes about lower interest rates fused through the economy. Actual experienced activity, though, remains very weak, says ANZ New Zealand Chief Economist Sharon Zollner.
We saw a big lift again in business confidence, up another 10 points to a net 61% of firms thinking that better times lie ahead. Now, admittedly, that's not necessarily saying a lot. When you ask firms about how the last month has gone, it's still deeply in the red, but we did see a small lift in past own activity. And in fact, the results that came in later in the month were better again. Still in the red, but maybe a few tentative signs that things have found a floor.
Number 5. In Australia, private sector credit growth was 0.5% in August from July, which was in line with expectations overall. However, the picture was varied within the figures. ANZ economist Maddy Dunk says business lending was strong, but there was a dip in housing lending growth.
there are signs the housing market is starting to slow slightly. So if you look at monthly housing price growth, that's started to pull back. If you look at auction clearance rates, they're looking quite soggy, and things like the median time that a dwelling is on the market has also risen. So all signs that there is some cooling in the national market there.
Maddy Dunk there, who we stay with for our bonus deep dive interview today on the latest biannual ANZ CoreLogic Housing Affordability Report for Australia. Maddy says while housing affordability deteriorated in June overall, there were some pockets of good news.
So we saw that nationally housing affordability does continue to deteriorate. But one of the interesting things in this report is that it's not deteriorating everywhere. So if you look at Melbourne, for example, one of the consequences of the fact that housing prices have been moving backwards is that affordability is improving for households. So a bit of a silver lining there because there is some pessimism around the Melbourne market at the moment.
Why has there been an improvement in affordability in Melbourne relative to other parts of the country?
Well, we tend to see that affordability improves if housing prices move backwards and incomes either rise or are stable. And what has been the case recently is incomes have been improving and housing prices have been moving backwards. So that leads to that affordability shift. Now, we do know that in the Melbourne market, there are more sellers than there are buyers at the moment. So there's a surplus of supply, and that has been pushing down prices, which is leading to some of these affordability gains.
And just looking at the time to save a 20% deposit, I see that that is up in most places, at least relative to a couple of years ago. How much of an issue is the time to save a deposit for most home buyers?
Look, we know that it's really challenging for people who are trying to get into the market. So it's 10.6 years nationally to save for a deposit. And when you're on that rental treadmill, it's hard to get off. I think that what we are seeing is that it's just becoming more and more challenging for most households to get their foot in the door. And particularly in some of those smaller capital cities, because we've seen such rapid price growth in places like Perth, Adelaide, Brisbane, the consequence of that is that it means those markets are now less affordable and more challenging for buyers to actually get into. So it is a challenging one. If you look at Melbourne, we did see a slight shift down in the number of years to save for a deposit. So it went down to 9.5 years, and that's compared to a record of 11 years back in 2017. So some improvement there, but I think the broad story across the country is that it's really challenging. And when you think about the pipeline of building activity going forward, it looks like it's going to continue to be challenging.
Yeah, and I see that the portion of income to service a new mortgage in Sydney, for example, is now nearly 62%. I mean, what does that mean in reality? Because there must be some first home buyers out there.
Yes, well, the thing to remember is that obviously we're not seeing people spending 60% of their income on servicing a mortgage. So it's based on the idea that the median household on the median income has purchased the median dwelling. So there is just this arbitrary nature to the calculation. We're not seeing people spending 60%. The banks won't loan for that. But I think it just really highlights how challenging it is for households to get into the market, particularly in Sydney, also places like Adelaide and across the country. It's around 50% of your income that would be needed to service a new mortgage. So it's really challenging.
And just looking across the capital cities, it seems like Darwin is the odd city out in this story. I suppose it's a function of available jobs and demand and that sort of thing. Can you tell us much about Darwin?
Yeah, well, when you look at Darwin, you look at the portion of income required to service a new mortgage, it's much lower than most of the other capital cities or all of the other capital cities at around 25%. And I think that that's a reflection of what we've seen with housing prices. Housing price growth hasn't been as strong in Darwin, particularly if you look at population growth recently. We haven't seen that strong population growth in Darwin relative to other parts of the country.
Maddy Dunk there. That was 5 and 5 with ANZ for Tuesday, October the 1st. Catch you tomorrow with the latest on Australian retail sales and analysis of Chair Powell's latest speech this morning. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. please view the podcast disclaimer available via your media player or email.